Welcome, everyone, to this special edition of Mediation Matters. It's really nice to see all of you. There's still people filing in the door. I wanted to take a moment to give a brief land acknowledgement and then introduce our guest speaker, Kate Phillips, for this edition of Mediation Matters. We'll be learning all about chip reverse mortgages and all that good stuff. Before we get there, I just wanted to acknowledge the land I'm standing on today is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, and the Chippewa, and the Haudenosaunee and Wendat peoples. It's home to many First Nations, Inuit, and Métis people now, and we and I deeply recognize their historic connection to this place. As a settler myself, I'm deeply grateful for the opportunity to work here, to live here. We're all talking about the storm that Mother Nature is bringing later this afternoon. Right now, I'm grateful for the cold but fairly pleasant weather to walk my dog in this morning. So I invite you to also think about what you're grateful for about living on the land that was taken care of. Thousands of people from the Indigenous community for thousands of years before we got here. So thank you to them and welcome to Kate Phillips. So Kate, I'm going to just spotlight you for a sec just so people can see you. Um, and just so you're not feeling a little bit weird, I'll also spotlight myself just so that it doesn't feel so odd. I want to introduce Kate to you. So Kate actually has been here on Mediation Matters as a speaker for us before on the chip reverse mortgage. So Kate is a business development manager with Home Equity Bank in Southwestern Ontario. Kate is amazing in terms of just giving you the information that you need. I had a client, and some of you will have, if you were on the last webinar with Kate, you will know that I learned about chip reverse mortgages when a client I had brought it as a solution that they had found, and it was fantastic. And I thought, what a wonderful thing for us as we're working with our clients to think about unlocking equity, allowing one spouse who wants to keep the matrimonial home to do that and pay out the other spouse without putting them into monthly turmoil of like high mortgage payments, and just being able to live for those last few years till their kids are maybe done school and they want to sort of make that transition. So Kate, you reached out to me and I was like, yes, I want our members to know about this. And I think, especially with today's climate, there's been a lot of changes, and Kate will tell us more about what's going on in a minute. Um, but Kate joined Home Equity Bank in March 2023. She's been a business development manager for over 3 decades in the real estate services and investment industry sectors. Kate supports and educates financial advisors on the opportunity for chip reverse mortgages, and therefore all of our clients who are 55 and above. And as we sort of look through the lens of the Great Divorce and a lot of us experiencing mediation clients who are in that age category, I thought it'd be great for Kate to come back again and talk. So without further ado, I will hand it over to you, Kate. Kate is going to share her PowerPoint, and this is also being recorded. So I'll take my spotlight off and over to you. Thank you.
Perfect. Thank you so much, Marianne. I'm going to double check, and I just did, and it wasn't being shared. So 1 second, I will share my PowerPoint. Can you just give me the thumbs up or say it's okay? You can see it okay? Good stuff. Thank you. All righty then, and thanks again for this opportunity. I'm going to do like a formal PowerPoint presentation and share some things with you, some ideas, some features and benefits, and even some case studies with you today about how the chip reverse mortgage has really helped a lot of families with their particular situation. I do know that you're family mediators. I also know that there may be some other people that you do know in the financial world that you're just going to know a little bit more about chip reverse mortgages and be able to share the story, the as I said, features and benefits with them. And it may be a family member as well. It could be a friend, yourself. So really this is meant to educate you on the workings of the chip reverse mortgage and a little bit about who we are, Home Equity Bank, that is. That's me and my contact information, which I also will have at the end. But you can reach out to me anytime, a question, perhaps a prospect that you're wanting to just discuss with me. I'm your go-to person at Home Equity Bank with respect to the chip reverse mortgage. You may recognize this fellow. This is Kurt Browning. He's an Olympic figure skater. He, as well as, and I bring this up because he's, does a lot of our television ads. This is where your friends and family and perhaps your clients will see about us, by looking at a TV ad and thinking, oh, I'm curious about how this works, like Marianne's client. And they might call us directly. And that is one avenue in which the chip reverse mortgage exists for clients. They can call us directly, they can talk to a specialist there, and they can actually fund a chip reverse mortgage by calling us directly. So Kurt is one of our amazing Canadian icons who helps us with our communication. Excuse me. There's also Peter Mansbridge. I think a lot of you know Peter Mansbridge. He joined us a year ago. One of the things that occurred with Peter was, as we know who he is and what he does for a living, being on the national and being a broadcaster and things like that, a podcaster, is he had some incorrect information. His thoughts were not correct sometimes. And so once our people, our marketing people, got wind of that because they interviewed him. He said, I want to help you get the word out about this product because I misunderstood it. I didn't know it worked this way. I didn't even know you guys were a real bank, he said. So he joined us a year ago and he's now doing a lot of our communication and our television commercials. So I just wanted to bring that up on the screen because some people say, oh, that's you guys. Okay. Anyway, we'll move along. The agenda, as I just shared, a little bit about Home Equity Bank, talking about aging readiness and things like that, just because it's good to know like what we're all being faced with, what maybe our parents are being faced with, friends and family and clients, in terms of aging readiness. Chip reverse mortgage, of course, we're going to talk about, and a couple of chip stories and situations that I have helped clients with in the last couple of years that I've been here. We also know that, in the press, there's a little bit more about reverse mortgages. Don't forget about them. They could be a viable financial planning solution. The likes of Globe and Mail and Rob Carrick, who I don't know if some of you know him at all or read his articles. He can be quite negative, pessimistic, and he's actually talking about don't forget, the equity in your home can be a very viable solution to some people, as Marianne mentioned too. BNN, Toronto Star, and La Presse in Quebec. So we're getting a lot of attention in the press. So that's great for us. This is a couple of stats that we have gathered about the financial reality of Canadians 55 and better, we say. So negative cash flow. Believe it or not, the average 65-year-old Canadian has an income shortfall of about $20,000 a year. So when financial advisors and perhaps yourself, when you're doing the financial analysis for your clients, it may depict that, oh my gosh, you know what, there's going to be a shortfall at some point. They're taking money out of their RIF or their savings in their RSP, their pension plans, etc., are going to provide them with income for a certain period of time, and then what? So that's pretty compelling stat there. Also limited pensions. Speaking about clients' pension, private pensions, where employer pensions, 39% of Canadians between 55 and 64, do not have an employer pension. So that's not part of the discussion. They don't even have one. Some of them, 39%. So that's kind of alarming as well, and good to know. And then many Canadians will outlive their assets. We're finding that out from financial advisors that we work with, that Canadians have saved less than $200,000 for retirement. So again, where's their income going to come from when that does run out? The median, and with our product, actually, this may be something that will be new to you or news to you, is that, the client doesn't have to have a free and clear property. They could still have a mortgage. It's just that we would have to pay that out first. But here's the median mortgage value for 65-year-olds, 65-year-olds plus population is about 100,000. So again, we do have to pay that out and be in first position, but nonetheless, I just want to make it clear that the client does not have to have a free and clear property. And 43% of Canadians, older Canadians, net worth is tied up in home equity. I mean, that's the good news. is that they do have that real estate, they do have the ability to tap into home equity, and it can be in the form of a CHIP reverse mortgage. So what are some of the fears that Canadians are experiencing in this the retirement 55 plus market anyway? Is they're afraid they're going to outlive their savings. I know that my conversations with my friends and with advisors clients is of that, like, I'm afraid I won't have enough. And they're losing financial control, and they're worried about financial or health, declining health dependence. They're going to have some health care in their home, or they're worried about having to go into a care facility, and they maybe haven't planned for that. So this is often, quite alarming too, right? Or evident about Canadians 55 plus, that they have some fears. And talking to them about this product can maybe alleviate some of those fears. This is an amazing stat from Ipsos Reid, and it states that 93% of Canadians 55 and better, we say, want to age in place. They don't want to be taken out of their home. They want to bring care in. They want to renovate their home to accommodate this situation that they may be in. And they, hopefully are making that really clear to their adult children that, down the road, my primary goal is to stay in my house, maybe till, we pass away. Um, Again, there's some more accolades in the industry, in the press. Reverse mortgages are an idea whose time has come. And those are very current, and, renting, downsizing. We're often doing webinars about the choice of downsizing, getting a home equity line of credit. Some clients in this age bracket will still qualify for a home equity line of credit with their income, and they can support it. But there's also a lot of those that do not have the income to qualify for conventional products. I mentioned at the beginning that our product can be accessed through all the banks. All of the banks, credit unions, would offer our product when they're talking to the client, perhaps about having to decline them for a conventional product. They're saying, well, we can now offer you the CHIP reverse mortgage. So that's another great news story. So Home Equity Bank, just to give us some history, CHIP is our brand name. It started out in Vancouver. An accountant 38 years ago thought of this idea of taking home equity out of the home. So 38 years of history. So we were known as CHIP, Canadian Home Income Plan, for up until 2009, actually. And that's when we became a Schedule I bank. So Home Equity Bank, and then the product is called CHIP reverse mortgage. We get asked that a lot. There's some confusion out there. We are a Schedule I bank, as I mentioned. We are downtown Toronto. And we just surpassed, Marianne was asking me just at the beginning of our call, just how's it been? What's your year been like, your past year? What's it like, now in 2025? And it's such a pleasure to say that we just had our record year in our whole history. In 38 years of history, we've just had our record year. What does that mean? It means that we brought in about $1.4 billion in reverse mortgages just in 2024 alone. That brings us up to about 8.7 billion total. We only do reverse mortgages at Home Equity Bank, and then GICs, which help fund our reverse mortgages. So our GIC lineup is amazing too, if you're curious. People often say, well, with that kind of business coming in with reverse mortgages, your GIC rates must be pretty darn good, and they are. We're kind of top of the list, so you can have a look at those too. But this is what we do, and I don't want to say it's all we do as sort of a negative. It just means that we are the first of all, the founders of this product, the innovators, but also the leader in this space. We have helped over 30,000 families. As we like to say, we've changed the lives of 30,000 families with our product. We have a book written about that. We are a real bank. So clients love to hear this too, is that 2 years ago, we were bought by Ontario Teachers Pension Plan. I've had people's arms go up in the air when I've talked to them on the phone, and clients, they're like, oh my gosh, I can't wait to tell my children that. They were skeptical. They didn't think you guys were kind of real. And being owned by OTPP it gives us a lot of clout and a great great ownership, and they're also working with us to help use our product for other purposes. And I'm going to share a little bit about that in a minute. So 39 years of history, or we're in our 39th year, and we've never been busier. So that gives a good indication of really the popularity of our product, the need for the product, and also the role that I have in educating people on the product is just, going gangbusters. We need to keep doing that, and changing the lives of Canadians. Um, this Canadian real estate market slide is a little bit outdated, but I think it's important to note that, homes continue to appreciate. Real estate is super important. Yes, we have our investment portfolios, but a lot of us, we have a real estate portfolio as well. And because the clients will keep owning their home, we do not own their home, they continue to, is they get to benefit from its appreciation throughout the life of a reverse mortgage. So we were just talking about, the average home value in Canada has increased 292% in the last 21 years. Oh my gosh. So it's really important. And a lot of people, as I shared earlier, have equity in their home, that they're able to tap into. And if it's not now, maybe later. Um, a lot of people think like, I don't want to do this now. I don't want debt right now or more debt right now. But knowing that they can do this at some point in their lifetime is such a relief. It's an asset that can be tapped into and can benefit them down the road if they wish. And we're going to talk about the benefits now. This is always such a pleasure to share about, dispel the myths as I'm going through it. But I was telling Marianne at the beginning, like one of the things that even our TV ads, I think, can cause a little bit of confusion is we say you have to be 55 and better, but we also talk about the 55%. And the up to 55% is sometimes misunderstood or just not heard as much as we'd like. So we don't loan everybody 55% of the equity in their home. That would put us probably in a really bad position down the road sometime. And also the client. Like if a 55-year-old was loaned 55% of the equity in their home, my goodness, 30 years from now, they might owe us more than they own, and that we don't want them ever to be in that position. So we take into consideration people's ages. Yes, all title owners have to be 55 and older. But that matters. So how old are they? What is their gender? Women live longer than men. And where their property is, rural versus urban. We are reimbursed or paid back and interest owing on that reverse mortgage when the home sells. So it's important to, manage our risk accordingly, our risk and the client's risk. So we take into consideration where that home is. So we will loan up to 55% of the value of the home in tax-free cash. So there's another benefit on the other side of our spider diagram here is that this is tax-free money. So when clients are looking and with their financial advisors, who I talk to a lot, when they're looking at their portfolio and they're saying, I need more money, I need to increase my monthly income, that's could be a taxable event. This is not. So tax-free or taxable is sometimes the choice that needs to be made. And the attraction is that tax-free nature. Going up the left-hand side, as I mentioned already, we're not forcing anybody to sell their home. We do not own the home at any point in time. We don't ask, we ask, well, we do ask about their current secured debts. We do have to pay those out first. So that's important. We pay those out. We do that for the client. We use a title insurance company called First Canadian Title. We use all of their services associated with the legal aspect of a refinance, which is what this is considered. We pay those out. And if they have some other debts they'd like to be paid out, well, we would pay out the secured. They have to pay out their unsecured, but nonetheless, we talk about their whole debt situation and how this could really eliminate their debts and their monthly payments. So no need to sell. We're never going to force them to sell their home, and they stay on title. There's no required payment. So we don't require a payment. Sometimes client ask us if they can make payments, and they can. So we talk about that. They can make up to a certain percent of what's outstanding every year, and they can make interest-only payments, but no required payments. which will be quite different than what they're used to with their conventional product. And because we're paying those out, there we go. There's no more monthly payments at all. So clients will have that extra cash flow in their bank account every month. Um, we talked about it earlier that they will still benefit from appreciation of the home. So we take that into consideration when we're showing them the numbers, is that don't forget, as you own this home during the life of this reverse mortgage, you're going to benefit from its appreciation throughout. And they're always quite astonished by, oh, so in 10 years, I'm still going to have X amount in equity of equity in my home. Absolutely. Um, and there's no requalification. First of all, how are they qualifying at the very beginning? It's their age, gender, and the value of their home that we're taking into consideration. So equity in the home is what qualifies them, not income. And it does depend on age, but that's all, right? There's no requalification throughout the term of this reverse mortgage either. It's not like, okay, you were 60 when you implemented this, now you're 65 and we need you to requalify. Absolutely not. So that's what's quite different than with a traditional conventional mortgage. So that's it in a nutshell. I'm also going to share with you, clients will often ask, like, do I need to take it all up front? Do I need to take can I take some now, some and have some for later? Can I just pay off my mortgage and leave it at that? Absolutely. The answer is yes to all of those questions. So there's different ways to withdraw the funds. The other one is income, monthly income, I should say. So we call that income advantage. And I have a nice case study or story to share in a little bit that will help illustrate how that product was used for a couple. Um, and also there's options for in certain areas being loaned more than typically we would just because of where it is and their situation. And also, an open chip, which is for people who maybe have their house up for sale and they need some money in the meantime, and they don't want any kind of prepayment penalty because they're going to pay it off as soon as the house sells. We have that option available to call it sort of a bridging opportunity. And we call that chip open. So there's different versions of our product. There are ways to withdraw the money. But we talk to the client, we know the goals. You tell us what the objective is for your particular client situation, and we'll make it happen in the best way that we can, using all of these options, or at least educating on them. Some of you may be curious, I get asked this all the time, what is your typical client? What is their typical age? How long do they have the reverse mortgage for, in terms of your experience? So our average age is 72. It's not in the 50s or early 60s, it's 72. The average loan to value, meaning how much are we loaning to the client on average, it's about 30% of the equity in their home or the value of their home. The average amount of the mortgage is 225,000. And the average home value is about 750, and we're across the country. It's Canadian, in all provinces it's available. And the average home occupancy is about 11 years. In other words, a 72-year-old, 11 years. So, that is the average. I would say the plan should really be about 5 years plus. And that is also the reason I say that too, is that there could be a prepayment penalty if the client does pay this off sooner than in 5 years. Other than that's why that open option is available for those who say, you know what, no, this is just going to be a short-term solution for me. Then we're going to put them in a different version of the product. But that just gives you some idea of the average age and typical scenario. I think we've talked about, what is a reverse mortgage? I think we do know. This is, dispelling the myths, which I think I've already done in terms of the features and benefits that I just shared. So I won't repeat it, but one of them that's on here is that myth that the interest rate, the cost of this product is astronomically high or high. That is not the case, and I'll give you an indication of that by talking about our rates. And I will start with a general statement that our product, the chip reverse mortgage interest rate, is typically about 1.75% to 2% higher than a conventional product, a conventional HELOC, a conventional mortgage. And that's because there's no income qualification. There's a premium for that. No income qualification and no requirement to make a payment. So we need to charge, the interest rate is higher because of those two features. So when clients are in the bank, again, the rate will be the same for a chip there as for a chip for your clients, but the rates are not that high. Our HELOC is sometimes a 5-year HELOC is sometimes at a higher rate than our 5-year fixed rate on our chip. Again, the rate does depend on where the client's home is. The rate could be a little bit higher I'll just pick on an area like we were just talking about Stratford, will be a little bit higher than a Kitchener, Waterloo, Cambridge, Guelph, as an example, or Toronto, Oakville, Burlington. So we can share that too. Obviously, when we talk to the client, we'll share their specific situation and what their interest rate would be. There's a whole bunch of stages in retirement. There's the early retiring years or the building years first, save, save, save. And then there's the, sort of the 60 to 70 year old range where I always refer to it as the go-go years first, and then the slow-go years, and then the no-go years. And those three stages are where we could help a client with a chip reverse mortgage. And it's a lot of fun to talk to clients about that, like what their goals are. They just want to travel some more. They've got lots of energy and good health, and they just want to be able to do more with, take tax-free dollars and go travel while they can, kind of thing. And then there's those who are, have some mobility issues, some health issues, and they want to bring care into their home. They need to renovate their home to accommodate their health issues. And then, of course, there's the later years, the maybe no-go years where they need even more care and more help in their home, and they need money to be able to make those changes. As we all know, and I talked about it already, the taxable situations and the non-taxable. And so on the left-hand side, we've got savings, we've got a registered retirement savings plan, employer pensions, and CPP and OAS. Incidentally, our product are the chip reverse mortgage proceeds, the income coming from it does not affect CPP or OAS. There's no clawback, excuse me. All of those are taxable. And on the other side is the real estate, the principal residence too, by the way, tax-free cash flow. So that can be on its own the most compelling reason to tap into the equity in the home. So many uses of the funds. This is not an exhaustive list. And as we know, this group together today, talking about gray divorces that happen in later years, that does happen, as you well know. That is one use of funds. We've done webinars on this subject. And all of the other ones I think I've already alluded to, but, just that tax-free aspect, being able to draw money from the equity in the home is a tax-free. That has a tax-free benefit, but there's the aging in place and bringing healthcare into the home. Debt optimization, like I shared already, some clients just want to get rid of their debts and have no more monthly payments and not have to make a payment to us and just leave it at that. That can make the world of difference to them. There's also the living inheritance aspect. We talk about that a lot. In fact, it's a good time to mention that our owners, Ontario Teachers Pension Plan, have just helped us we do this all the time where CHIP proceeds are being used to give to children now while the parents are still alive or grandparents are still alive, that living inheritance, bank of mom and dad. But we now have a product called Homebridge, which is available on our site. We can send you a link to it whereby we can facilitate straight from chip reverse mortgage proceeds to kids' down payment on a house. And I say straight to, I mean, there's a few steps in there, but it's a lovely package with a bow kind of product that has just been launched. And I'm happy to share more about that. But really, it's just a facility for making this happen, which we've already been doing. It's chip and then helping kids with down payment on a home. There's, crisis situation, which is the gray divorce aspect, retirement income, just sustaining, their standard of living by just needing a little bit more income to come in together with a pension plan of some sort. But increasing the income is often the reason for doing the chip reverse mortgage. Here's an example of a gray divorce situation, and you're well aware of all the requirements to when you're working with a client going through a divorce. But this is just an example of one of our cases in BC. They owned a home together in North Vancouver. They've amicably, they're splitting up and they have a portfolio. And obviously that's going to be a 50-50 split or what have you. I don't want to get into the details. You guys are the experts in that. But nonetheless, is Mary in this situation? Mary and Bob. Mary wanted to stay in the home and pay out Bob. So we were able to facilitate that with a chip reverse mortgage. And all of the benefits, are there whereby, this is a tax-free situation. Obviously, in this case, there was a bit of a shortfall. So there was, money that needed to be withdrawn from her portfolio. But for the financial advisor involved too, like this means the clients both stay as clients, and the portfolios, whether, they're not in the same name, like they've been split up or some money has been moved over to Bob from Sue, etc. But the outcome is amazing in that Sue is able to stay in the home, and Bob is, there's that equalization aspect going on at the same time. So we work with, as I said, with you on this, getting, the documentation, getting the separation agreement at the outset. I have a mortgage specialist that supports me, that partners with me. I'm not the mortgage specialist, so they work with the client, getting the appropriate documentation, and as well as First Canadian Title, they're instructing us too as to what is required to make this all happen. So that is a very common situation, unfortunately, but as you're working with these kind of clients all the time. But I'm not going to go through the calculator necessarily today, maybe if we have time, but if you want to write this down, chipadvisor.ca is where all of our resources are housed. Our calculator right here, let me just try it. Sometimes when I share my screen, it doesn't, you know what I'll do? I'll do it a different way. I'll just stop sharing my screen for 1 second. And we can put in a little bit of a scenario so you can see how it works and what information is required. And I'll share here. Marianne, can you see that? A calculator now? Okay,
Yeah.
I see another nodding head. Thank you
Yeah.
very much. So this is a better way to do it. This is our calculator where you can put in a specific scenario, and I'm just going to click away here and put in a 65, or actually we'll do our average age client, which is 72, male and female. This is how easy it is. Just to give you an idea, we'll use that 750,000 average home value that I shared earlier. Single family dwelling, but we can do this on a condo and a townhouse. And I'm just going to use a postal code right here, and that's in Oakville. Postal code. This is all we need to get a rough estimate of what the client may be eligible for. And I'll just click see rates, and all that does is it will give all the options available. So variable 6-month, it depends on which version of the product we're going to choose, whether it's that lump sum or income advantage situation. But right here, 5-year rate in Oakville, 5-year fixed rate is 6.69%. And I don't know if that, pleases you, but I know a lot of people say to me, oh gosh, I thought it would be a lot higher than that. So that gives you an idea of what our rates look like. In other areas, well, it doesn't matter, but there are other areas I'm familiar with their rates, like 7.29 in a smaller rural center. And as I mentioned earlier, we're looking at our risk in those areas, because we are going to depend on the home selling down the road, and we just want to make sure that we manage our risk accordingly. But that's all we need to know. And now up here, it tells you that the client's eligible from anywhere from 324.5 to 337.5. Just because Oakville is a prime area, Toronto also is, Kitchener, Waterloo, Cambridge, Guelph, London, Vancouver, Montreal, they're all prime areas. There's a lot of them. And we can loan a little bit more in those areas. So we're letting you know that that's the case here in this situation. And then what we do is create a financial illustration, which we can change any of this. Let's suppose this particular client, the divorce situation, just needed maybe $100,000 to give to their former spouse or what have you. We can change that right here. This has got the full amount on the lower range in here, but we can go and change that and just make it $100,000. Maybe that's what they want to give one of their kids. And we leave everything the same. We're going to choose that 5-year, which we kind of already did. I clicked on it earlier, but we can change that. We can display 10 years of information. And we're going to assume that the home appreciates 3% a year for the 10 years. That can be changed as well. And I'm going to click on the financial summary. Nice picture, but what I really like is this one where we download a financial report and show, second, each year for the next 10 years, what this could look like, what the interest cost is every year, what the remaining home equity is at the end of each year. And of course, we don't know what the rate's going to be after 5 years, so we just put in our posted rate for now. But this is great at showing clients, at the end of 10 years, your home will still, given 3% a year appreciation, paying back the reverse mortgage of 198,007. Oh, sorry, no. Yes, 198,784 is 809,000. This is a great illustration of how the product works, what it's cost them and what it could look like in 10 years. They're always surprised by this. Like, oh, so my home was worth 750,000 and at the end of 10 years, it's going to still be worth 809, having borrowed $100,000. So this is what's available to you anytime. You can go and play with this. You can show your clients. You can call me and just say like, is this how it works? Is this, etc. Like questions come from this all the time. But you're welcome to use that site. And I can follow up with an email, Marianne, too, with some of this in it so that there's no, there's lots of things to be clicked on, etc. And I'm going to go back to my PowerPoint just for a second. We're okay for time?
Yeah, really good. Yeah.
Okay. So back in here.
That's a great tool. That's a helpful one. I think
Yes.
the visualization of the like how the equity grows and really essentially pays for the loan is something that I think could
Yes,
help people. Yeah.
exactly. Okay, so now I'm just going to blow this up and you can tell me whether that's being shared. Can you see that? PowerPoint again. Good.
Yep.
Okay, thank you. Okay, so just a couple of other, and I'm not going to click through every one of these cases. I just want you to know that we have many situations. They fall under what I shared earlier about common uses of the funds. But generating retirement income is one of them, where this fellow, he owes $100,000 on his mortgage. He has 140,000 in registered investments, including his RIF. He also has a defined benefit pension plan worth $86,000. His registered investments are going to run out at the age of 83, leaving him with an annual cash flow shortfall of about 18.5. So in this case, the advisor has talked to him about taking some equity out of his home. And he's 68 years old too, by the way. He's got a condo, and his debt payments are about 640 a month, 7,680 a year. So we're going to get rid of those payments and do a chip reverse mortgage for him. So he was his home value was just under 600,000. We paid out his mortgage of 100,000, and we're going to do. Whoops, sorry, click too far here. He was approved for 255,000. So he can take that as tax-free cash, as I mentioned, keep his investment portfolio intact. So that tax savings is huge too. And his monthly income is now like what he doesn't have those payments anymore, so his cash flow has increased by that amount every month. Sometimes clients just leave it at that and don't take any extra. They just want those payments, removed. So that's a good indication of generating retirement income. This is a really nice one that I like. It's sad but very common where there's two, spouses, Mr. and Mrs. Mr. in this case needed to go into a long-term care facility, and Mrs. wanted to stay in the house, and so paid for Mr.'s care by doing that income advantage, that monthly draw to pay for his care. So she is in the home, and he's being taken care of as well financially by taking the equity out of the home. Another one is this situation, Olivia and Lee, 69 years old, enjoying their home very much and want to stay there. But they recently, investigated a reverse mortgage with their financial advisor. Their expenses about $7,000 a month, so they're having a good time. They have investments of about 645,000, home value 1.3 million. And we just basically, and this is what we can do for you as well, is talk about what their options are by putting a case study together. So there's their traditional financial plan on the left-hand side, showing a shortfall at 81 or at 83, and then using the example of taking a monthly income from their home equity to help fill that shortfall. So we get into some pretty big details with clients if necessary and helping them see the advantages. And sometimes there isn't an advantage, right? They're better off to go the traditional route. But nonetheless, they like to know that they have this choice, and maybe it's later on, depending on their age, etc. But we help them with that and help you with this conversation and providing a plan. Living inheritance, this is a really neat one too. David's a widow, 74 years old. He's got a couple of properties, I gather, and he has two adult children. One of them needed help with a down payment on a house, and the other one, he just did the same for them. They can use the funds in whatever way they choose, but nonetheless, he's facilitating that living inheritance while he's still living and can see them enjoy it, etc. And he has the ability to do that, owning 2 or 3 properties. And by the way, we can do a chip reverse mortgage on up to 3 properties as long as one of them is the principal residence. So, the principal residence cottage, perhaps in a rental, we can do a blanket chip reverse mortgage on all 3. Yeah, that's just a little bit more information and idea of how we can help you with the numbers and presenting the case to the client or the solution. It can also be used to purchase another property. Again, that may be just up for discussion with your clients. The chip can be used to facilitate that too. So I just wanted to share a little bit about the support we offer you too. Again, I'm part of what's called the wealth team at Home Equity Bank. So we're supporting financial advisors and financial, I'd say counselors like you guys are, in any way that we can. And so what that means is that you're not having to submit applications. You're not having to fill out any paperwork for us. You don't even need to get any of the supporting documentation. I can do that. Our team, I'm partnered with a mortgage specialist, as I mentioned earlier, so very much a personalized support team. Different than if a client went into the bank, that banker, that personal banker, that mortgage specialist at the bank would be doing a lot of the work. Whereas me and my team do the work with you. You can do as much as you like. You can be part of calls. You don't have to be, but we kind of take it from that lead, that idea, you sharing that with me, right to funding, just with a specialized team at Home Equity Bank. We don't talk to them about anything else. We don't, talk to them about their investments or anything like that. We just gather information and present them and you with a solution. One thing I wanted to mention is part of the process, the beginning of it all is an appraisal. Like, we have to validate our numbers. You can use that calculator and put in the home value of 750, but we're going to validate all that with an appraisal. First Canadian Title does that, has appraisers that we use. And then there's the setting up of the chip and paying out the debts and checking title, and who's on title and making changes to title if necessary, which may be the case in a divorce situation. We use them for all of that. There's a setup cost for that. Share that in a second. And then the third part is the independent legal advice piece. We want the client to seek independent legal advice. And so if any of you are lawyers and would like to be, participate in that part of what we do, please let me know that too. Because we can, we can refer clients to you as a lawyer. We'll talk about that when I talk to you individually, but I wanted to just mention that today. We have a great book called Home Run. I think last time, Marianne, I shared the digital link with you, but
Yeah.
I'm happy to, yeah, get this out to you in physical form, whether it's meeting or mailing it out. I'm happy to do that too. It's a phenomenal book written by our president and marketing VP. And it's got interviews with Peter Mansbridge in there, but stories after stories that will really help. You can give it to the client to read about it. There's my information again, my email address and phone number, and happy to support you in any way I can. And I'd love to turn it over for questions if there's time, Marianne.
Absolutely. Yes. Yeah. Thank you so much, Kate.
You're welcome.
Um, do you want to, we could stop share maybe so people
Yes.
could see each other and then, but if people need
Yeah.
that information, we can pop it in the chat too.
Right.
Yeah.
Sure.
That's awesome. Do you want me to remove your spotlight? That might feel better.
Oh,
There. Feel better?
yeah.
Okay.
I
Okay.
just look at
We can
you.
yeah. I know it's much easier. Okay, so
Yeah.
thank you so much for that. I think, it's really quite interesting that that is a potential solution for so many of, us as professionals as well as our clients.
Yeah.
Um, and I want to make sure I give space for people to ask questions. So if this is your time, would, any questions?
No.
So what I'm trying to practice here is that if you come to Insight Matters, Elizabeth Sterrett leads that program, and she talks about the art of using silence. And so she uses it so beautifully, and I use it not as well at all. I tried it, and I like to fill in the space. You can also use chat if you're not able to come on screen. And then like the question I had, Kate, was so if we make a referral to Chip and then it's like you work with the client, you'll sort of make an assessment of what product fits their situation the best. And did I get it right that you may also do a traditional mortgage through Home Equity Bank?
Oh, yeah. No, no, no. We would just
No.
compare it to,
Okay, just
they may
there.
be
Okay.
comparing it to, I'll refinance or I'll get a HELOC or what have you. We will
Yeah.
point out the benefits of both. That's what
Okay.
I meant. Sorry. Yeah, no,
I
we don't
see.
do anything conventional. That
Nothing
doesn't sound
conventional.
right either.
Yeah.
We're not conventional.
Yeah.
No.
Yeah.
No,
Yeah.
good question. Yeah. No.
Okay,
Um,
so although
can I
it's not,
ask a question, Mary Ann? Sorry, I won't be able to show my face at this time, but I do appreciate
is that
hearing
you,
the
Deborah?
fact. Yeah, this is Deborah.
Yeah. Go ahead and then Karen. Thank you.
Thank you very much. Thanks for your wonderful presentation, Kate.
You're welcome.
Actually, I'm been wondering for this kind of reverse mortgage, um, what would the amortization period be? Traditional mortgages have a long amortization period. So if the home equity bank were to take over, I mean, a traditional mortgage, what would the amortization period be?
Good
Because I
question.
noticed in your explanation, you mentioned the 5-year term. Yeah, but
Yes.
after the 5-year term, through, I mean, regular banks, they would renew it.
Yes.
Usually, most of the time,
Yes.
it would be renewed easily. So with a reverse mortgage, what would be the situation?
Good question, Deborah. Thank you. There
Thank
is
you.
no amortization. You can think of our mortgages as 5-year closed mortgages and then a reset every 5 years. So there is no, because we don't know how long the client is going to have this for. There's no maximum age. So really every 5 years is when there is a reset Because they also would need to, in most cases, change the term that they've chosen, like the rate that they've chosen. If they choose a 1-year rate, in 1 year, we're going to reach out to them and say, okay, now what do you want? Do you want a 3-year rate, 5-year rate, a variable? So that's one thing. But after 5 years, that's when that closed aspect has passed, and now they're into an open situation, but they still need to choose their term for the next 5 years, perhaps. So there is no amortization is really the answer to your question.
Okay, thank you, Kate. I have another question
Mhm.
from the answer you just given. So in that case, let's say the client has been given an initial 5-year term
Mhm.
with the reverse mortgage. And within that period, the bank gave them like a tax-free loan of about, from your examples, from let's say about 300,000.
Mhm.
And the initial equity on the mortgage was just about 700,000. So after the 5-year term, would there be anything left? I mean, let's say they could come back to Home Equity Bank to renew the mortgage, the reverse mortgage. So, I mean, what would be left? I mean, what could be done in such a case? Uh,
Okay, so are you this is a question I think that's being asked is,
mhm.
could they access more equity in their home? Is that what you're asking?
Yeah, what
And
I'm
they
saying
could
is that if they have
refinance?
already almost expired all the equity in the home, I mean,
Okay.
when you
Well,
gave them the initial five-year term, and
okay.
the client was allowed to take out a tax-free amount of, let's say, 300,000 from,
300.
let's say the equity
Right.
is exhausted
Right.
during the first 5-year term, and they now
Yeah.
come back and say they want to renew the mortgage,
Okay.
the reverse
Yeah.
mortgage. So what happens in that case?
Okay. So they
There's
wouldn't
no
have
equity left.
exhausted. Yeah, their home is worth 750. We're going to lend, and I chose a 72-year-old. So
Mm-hmm.
we would loan them that 300,000 roughly, right?
Okay.
So if they took all that
Mm-hmm.
at the outset, as the calculator illustrated, is they would still continue, their home is still appreciating. So there's still more home equity. There's still equity in their home, right? They can tap into that because they're now older. In 5 years, they're now going to be 77. They are eligible for more of that equity in their home. Their house is now worth more than 750, hopefully, right? Maybe not, because the
Mm-hmm.
market could have. So they could be eligible for more, but they definitely have not used up all the equity in their home. Like, we're not going to lend them enough that that would happen.
Sorry, please. I hope I'm not monopolizing. Sorry, Mary. I think I'll just have one more question.
Sure.
Okay.
With the reverse mortgage, would you initially take over the mortgage from the traditional, like the bank? Let's say Scotiabank is
Hmm.
the banker of that particular client. Do
Yes.
you, in such a situation where the client now comes to you for a reverse mortgage, a cheap reverse mortgage, would
Hmm.
you be taking over the mortgage from the bank, since the client would not be holding the traditional mortgage
Yes.
anymore.
Right. That's
It
right.
would be
We have
converted.
to. We have to pay that out.
All right. So
Yeah,
definitely it wouldn't be with the bank anymore. It would now be
that's
transferred
correct.
to the
No,
home equity.
no,
It will be
that's right.
transferred.
We're paying that out, so they have no
Okay.
more secured
Hmm.
debts. So if they have a home equity line of credit too, like that has to be paid out first. So of that 340, let's suppose they had $100,000 mortgage, they now have
Hmm.
240 in tax-free cash that will be deposited in their bank account, but they'll no longer have that Scotiabank mortgage.
Okay. So that means you're actually paying out. You in such a situation be paying the bank the
Yes.
amount left in the okay.
Yes.
Really well.
Yeah. Yeah. So
Sounds
that it no
sounds
longer
sounds
have
good.
a monthly payment to Scotiabank. That's correct. Yeah.
Really, is it really that good? There must be a catch somewhere. I'll look this up myself. Marianne, could I have this presentation? It sounds, sorry, I'm not being rude or
Yeah.
anything, Kate. It sounds so good to
Too
be
good to
true,
be
too good to
true?
be true. Yeah.
No.
You know what? It's very interesting you say that because that's what I actually thought at the beginning. Like I was
Mhm.
probably more like Kurt Browning, all of my skating skills are not that good. But where
Yeah.
I'm like, wait, what is this? And I was sort of worried for my client. And so I asked one of my friends who's a financial advisor, and she had just done it for her parents to fund their retirement living in a fancy place that was so nice for them. She just
Hmm.
did that so that they could pay for their care. Um,
Yeah.
and for some reason they wanted to keep their house for something. Anyway, they kept their house as well. And she's like, no, Marianne, it's good. And I was like, okay. And then I started, and I think Kate, you emailed me at a really good time, and I was like, okay, cool, I understand this now. So it like
Yeah.
I think the too good to be true part is
Mhm.
is like that's almost just like you forget, I think, that the house rises in value. And so the idea, I think the principle is, and Kate, that I'm going to probably really simplify this, is that the house just goes up in value so that it overtakes maybe the cost of
Right.
borrowing that money. And that's like sort of the goal. And then, they're going to make sure that, they look at the area, the valuation, there's a risk analysis, and that they don't want to get in trouble because they don't want
Right.
your house to be worth less than what you owe them. And that in turn protects you.
Yeah.
And there's a question about compound interest on the mortgages. I think it is. So you would
Mhm.
pay interest on the
Yep.
the interest that
And
is charged on
annually.
the
Yeah.
equity.
Yeah.
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 So that's your answer to the question, Julie. And then Karen had a question, I think.
Well,
Well,
thank
this sounds interesting. I wouldn't want to get ahead of the board. I just recently was invited to become a member of the OSCC board, and I would like to bring this to, you know, the knowledge of the OSCC board. I would like to speak to them first. I'm the executive director. I think this might be really interesting for them, for probably Kate, if you could come in. Please, I haven't spoken to them yet, but I think
Oh,
I will
sure.
speak to
Yeah.
the executive director to invite Kate to come and speak to the seniors, because I don't think a lot
Mm,
of people know about cheap reverse mortgage with home equity
right.
bank. This sounds so good to be true. So I think I would need to speak with the executive director about this. They should be interested
Love
in
it.
this.
Kate,
The
are you?
seniors need to know about this. Mhm.
Thanks, Deborah. Kate, are you okay to send a copy of
Yes.
the PDF of your presentation? Then
Yes.
if you are here and you want me to send that, just email me so that
Okay.
or
Yeah.
email Kate directly. If
Yeah.
you,
No, no, I'll speak to you, Mary, and you brought Kate in, so probably I'll liaise with you so that you
you
can
can,
speak to
you
Kate.
can do
I'll
that. Yeah,
let
that's
you know once
okay.
I hear
Thank you, Deborah.
from them. Yeah, thank you so
You
much.
bet.
Thank you, Kate.
Thanks, Karen.
You're
Karen,
welcome, Deborah. Great question.
thanks. Karen, you have a question.
Great. Thank you, Kate. This has been extremely informative because I did have a lot of those questions about this is too good to be true. I think giving proper referrals is really important. So this really helps me. And a lot of my questions were just answered. And it was really around how does the existing mortgage fit into that 55% calculation? So that's
Right.
for me now. But I do have one other question. And I wonder about, we had the scenario that we talked about earlier where the woman wanted to stay in the home and the husband wanted his money out. So would he qualify if he was going to take his money and buy a new home? So it's not an existing home, but a new home. Could he apply for chip reverse mortgage in that circumstance?
Absolutely. Yes. Yes. Can be used for a purchase. Another property. They may already have two and they want to buy another one. Absolutely.
Excellent.
Yeah.
Thank you
Yeah.
so much. Great presentation.
Oh, thank you.
That's so nice. I had one little last question, unless anyone else has one, because I don't want to step on everyone. Okay, I'll ask it. So in all the scenarios you showed, and it showed what sort of registered retirement savings they had and open savings, does that have an effect on, I guess, the risk of the person, or how does that play in? Or is it just like a fun
No.
fact?
No, yeah, it's just when we're talking about this being a solution, possible solution, is where
Yeah,
we're talking about, great, I could take more out of my RSP or my TFSA. That's
yeah,
tax free, but we're
yeah,
just saying like they've got these investment, great, but if you take more out of them, that's going to be a taxable event, and the chip
taxable
is
event.
not. It's
Okay.
just another I guess fact for the client. Yeah.
Hmm.
Hmm.
It's like in estate planning too, like to get that
Hmm.
money out is
Hmm.
probably like you could get it out and gift it, right?
Yes. Yes,
And then you
absolutely.
wouldn't have to pay it, your family wouldn't have to pay estate tax on that if you're getting close to saying goodbye. Or maybe you
Right.
knew you were gonna say goodbye, then you could maybe do that.
Sure. Yeah.
Right? Because then you wouldn't pay, then your family wouldn't pay estate tax on the money that was your estate.
Mm-hmm. Mm-hmm. The other thing that the question I thought I might be asked, and I should have mentioned it earlier, is we've talked about home value appreciation and at the
Mhm.
end, and what's too good to be true. is we also have built in, and part of the way we can manage it is by not lending everybody 55% or not lending everybody too much equity in their home or giving them too big a reverse mortgage, is we have a no negative equity guarantee built in. Let's suppose someone lived to be 100, 105 or what have you. You know, from 70 to, that's 30 something
30
years
years.
that they could end up staying in their home, and the proceeds of the original chip reverse mortgage, like they've taken it all now. Their house value has gone down when it's being sold, like it's a bad market or what have you. There could maybe be that they owe more than they own. We would
Mhm.
never ask them for that extra amount.
Oh,
That's our guarantee, no negative equity guarantee. That's happened in 38 years once.